Good day everyone, hope you are well. Today's video is going to go about high probability order blocks and fair value gaps. I'm going to show you an example of how I look at it and how I find it. Market structure plays a big role in it as well. I don't just enter from any order block or fair value gap. So let's get straight into it. If you like my videos, please go like and subscribe. Stay tuned till the end of the video to see how we would enter on this trade. Awesome, let's get straight into it. Alright, so as you can see, we need to identify market structure. When we look at the chart in front of us, it's literally you identify your highs, your lows, lower high, lower low, lower high, lower low. Then here we break it, so it's higher high, higher low, higher high, lower low, lower high, and so forth. So we identify the highs and the lows. Now you get internal market structure and you get your main, and you get your main market structure as well. So let's say, for example, we are looking at this high and this low. Anything in between that high and low would be your internal market structure. So on the lower time frames, this would have something like this: highs and lows inside of that leg, and that we call internal market structure. Alright, so when we look at this price chart here in front of us, the first thing that I need, or the first thing that I look for, is an impulse move. I'm not going to enter a trade that looks like this, like it's choppy and there's no impulse. Like this is a nice impulse move to the upside. This is okay, there's no like really impulse move. What I mean by impulse move is something like this: it moves away really fast. It moves away really fast. Same here. Yeah, it's choppy. Let me show you an example here. Now, which one would you classify as the more impulse move? This one or this one? Probably this one, right? Because you can see it moved away a lot quicker than that one. So let's have a look what's happening here. So for a high probability trade, when you look at market structure, we had a higher low, high, and then the low got broken here with that wick, literally that wick. So if we mark this out, as you can see, it literally broke that low with a wick, literally a wick. Okay, so when we look at this, we got our high, low, low, we broke it, so that's our new low. Now, how I look at it, if you go onto the lower time frames, you would see liquidity has been taken here. We have an impulse move. There's our last up candle before the down move. And then we have our huge, nice, huge down move. Alright, so now I would look at it as a high probability trade. I won't necessarily take this trade because this is painting the picture for me. Alright, now we got a move. Now we can enter nice and safe. So the impulse move happened from a point of interest. But I like, if you haven't watched the videos yet, I like for liquidity to be swept as well. So it's just like an extra confirmation. Liquidity was resting there and price took it out. Then we had a huge down move, and now again we broke this low. As you can see, we broke this low. Now what's resting above the 50% from this high to this low? So we're only going to enter above the 50%. That's going to be discounted area. Now what do we have there? We have an order block. Let's just delete this previous one. And we have a fair value gap. Now there's two ways you can enter from the fair value gap, for example. Both of the trades is a really good trade. Where will I target? I would target this low, because what's resting down there? Liquidity. So that would be my target, is this low. Let me just write there, target. Now let's say, for example, look at the difference in your risk to reward, right? So if you enter straight from the fair value gap, your stop would be above this high, and we would target this low, correct? As you can see, price immediately went down for our target. And this is on the 30 minutes, so this is a really good trade, especially for crash 300. That's a 1 to 6 risk to reward. Now your stop loss is a little bit big. Now what would I do if this is too risky for you, like the stop loss is too big? What I would do, I would get the middle point of this fair value gap, and I would put my stop loss, my entry, at the 50%. So then immediately it goes from a 1.6 to a 2.4 risk to reward trade. And that's how you can also enter from too big of fair value gaps. Now how I normally do it, I enter from the bottom of the fair value gap, the 50, and then I would also put a sell limit on the order block if price comes and taps in my order block. Now that's a nice trade. So now let's quickly move on. Let's see what happens. Now again, we got a big impulse move in this trade that we were in, correct? Do you agree? So let's see what happened. Let's delete everything. So we had that trade, all right. So let's say you just got into the market, all right. Now you can see we had an impulse move. We got this trade, another impulse move. All right, now again, where did this price made that impulse move? It was from a point of interest. Okay, so price reacted from a fair value gap with a huge downward move. Now let's read the story. Liquidity was taken before price entered the fair value gap. Okay, cool. Now made a huge impulse move down. We took this lows, so that's indicating to me we're still in a downtrend. High, low, high, low. Okay, from this high to this low, we want to enter a trade above the 50%. Now what do we have above the 50%? We have a fair value gap there, and we have an order block there. Let's just delete this one. Okay, so let's say, and where would we target? We would target this low, the low of this impulse move. Because what's resting down there? Liquidity. Okay, now if you enter from the fair value gap and your stop needs to be above that high, your risk to reward would be a 1-to-1 trade. It's a 50-50, 1-to-1 trade. So that's still a good trade. If you find this too big, again, the 50%, so that's a 1-to-3, risks is looking a little bit better. Or you can put your sell limit at the order block. In this case, as you see, we went to tapped in the order block, and we got a 2.8 risk to reward trade, and beautiful. Okay, let's follow the market. Here we are changing structure again. Of course, we got a nice, let's follow the structure: high, low, high, low, high, low, high, low, high. Here we broke structure, so indicating we're changing trend. High, low, high. We entered here from a point of interest, not entered, price reacted from a point of interest. Remember, I don't take buys in crash. Alright, now we need to break this high to confirm we're going in an uptrend. Alright, we broke it, the huge one. So now let's just follow price. Let's see what price is doing. Alright, so from this low to this high in the 50%, what's resting in the 50%? We have an order block here, and we have fair value gaps here. On the higher time frames, that would be 1 fair value gap. So we entered it, we broke this high. Okay, so we're still in an uptrend. Let's zoom out a little bit in the higher time frames. What's happening? Where is price going? So on the higher time frames, we consolidated. Huge down move there. Let's see what was happening here. Same high low. All right. There's a huge order block here. So let's say you extended this order block. Let's see where it ends up. As you can see, the reason I chose that one, before we go to the price, we had the same structure here, big impulse move, liquidity was taken, it reacted from an order block, entered from the fair value gap here or order block here. Now price went down, so we took our target there. Now again, this isn't a big impulse move. Here the impulse move starts. What was left behind? An order block. Alright, so now we tap the order block. Let's see what's happening. No impulse move, no impulse move, no impulse move. Alright, here's something happening. This is a small impulse move. Let's see what's happening here. So price reacted from an order block here. A big impulse move. Liquidity was resting there before it touched the order block. What's above the 50%? We have an order block there and a fair value gap there. Again, price tapped into our fair value gap. Price went down and we literally targeted this low. Nice and short trade. Alternatively, you can look what you marked out here. You can extend it. As you can see, guys, price is precise, literally, only by understanding market structure. Okay, what's happening here? Let's see. So let's extend this again. All right. Let's extend this. So we took this trade. Now you can also see it like this. Now we took this trade, but now what's happening here? Again, price went down, big impulse move. Is there liquidity that was taken? For me, you can take this trade. Let's zoom in a little bit. No, so that high is still a bit higher than that one. So I won't enter from one of these fair value gaps or order blocks. I caught that trade, yes, by entering there. But If you didn't see that and you entered, for example, from here, you see a fair value gap there inside an order block, so that's really good confirmation. Now you might ask me like, but why don't you target this low as a target? Okay, let's just extend this. Alright, so why won't I target this as my target for this trade? Because as you can see what happened here, we got a big impulse move from where the price was here, got a big impulse move. We changed market structure shift right here. So now we need to wait and see what's happening. It came down, never took out this low, and price is leaving an order block here. So we got a market structure shift, so I won't target that low. I'm still waiting for price to come up to this fair value gap with that big impulse move, and we entered a trade, but I would target the next point of interest when I enter here, just to be safe, because I don't know, I'm unsure if price is going to go to this low, because it's currently going on an uptrend, and I would put my stops above this one, and we got a beautiful trade. If you didn't take your trade out, for example, either you can go break even or you got stopped out there. But at the bigger picture, remember, these are the higher points of interest. We entered there, you can still leave it. The reason why this one will still be valid, because price hasn't gone through it yet, so it can re-enter. I get questions, but can I enter from the same order block or fair value gap? Yes, you can, but you need to see where price tapped on it. Did it tap it? Was it halfway through? For example, I won't necessarily enter from a fair value gap or an order block if it's more than halfway through it, then I'll leave it. But if it taps it like here, sure, it can. You see there, price filled the fair value gap. So now I won't enter there again because price folded there. But now I still have, let's quickly see, I still have my order block here. So that order block, there's an order block in an order block. But the most recent one would be this one, where that originally that first impulse move started from. That was the previous trade one. This one is the new one. Price hasn't tapped that order block yet. This was the fair value gap. So what did we create? We created liquidity. I won't enter yet. Cool. Big impulse move down. This is current price. We got our market structure shift again to the downside. So now this is going to be my target again. Now this is becoming my target again. But now I need to wait for price. What price is going to do. So literally where we are from here to here in the current price. Price is still in the premium zone. So what I would look for trades is this order block here. And this fair value gap here. Those are my points of interest of where I would enter a trade on crash. And let's say you entered here. Stop loss there above the high. You're going to target that low. That's a 2.2 risk to reward trade. Or you can put it in the middle of the fair value gap, or you can target the order block. And that's the current price, and that's where I would enter from crash. All right, I hope this video helps and answers some questions. If you liked it, please go like and subscribe, and then I'll see you in the next video. Cheers.